Let's start with a very, very simple question. What is the difference between Forex hedging versus just using a stop loss? Now, specifically in Forex hedging, here's the only difference. This is the real truth. The only difference is that when you hedge a trade, you take the loss in your open terminal. And then whenever you use a stop loss, or this is analogous to just closing the trade at a loss, you take the loss, but it's in your closed terminal. You still have to wait for the next trading opportunity to then either manage your hedge position or take a new trade. And then that new outcome is going to determine whether or not you can get out of that previous loss, whether it was a hedge loss in your open terminal or a loss in your closed terminal. That next trading opportunity will determine whether or not you get into more loss or you come out at break even or profitable. So I'm going to show you this concept on a chart and show you how literally you can do the exact same thing with stop losses as you can hedging. If you're new to my channel here, my name is Nick. I've been trading for a long time, like 8 years, and I make YouTube videos because I think it's fun. So let's go ahead and get here onto the chart right now. Let me first show you, actually no, we're just going to use replay mode. Let's go to replay mode. We'll go here to like the 4 hour. I'm going to click a random bar. We'll go back in the past. Okay, so this is November of 2022. So let's say we enter a buy right here. We're going to say this is a one standard lot buy. And let's keep it simple and just say we're using a stop loss. We're going to say the stop loss is down here. Let's say it's like $1,000 risk and the potential profit target is up here. So potential profit target's up here. Now let's just let it play out, see what happens. Okay, I was kind of hoping it would lose, but this one hit profit target. Okay, it's cool. So you have a profit target hit. Now let's sell. And then for this, we're going to sell here. We're going to say there's like a stop loss up here. And we're going to say there's a profit target down here. And let's just say for the sake of simplicity, we're risking $100 on this trade to make a potential of $100. Okay, so this in fact hits stop loss. So what we have is we have a losing trade here. Now, let's imagine that with this stop loss, it stopped out at $100, right? And this profit target wasn't hit. So this is a stopped out at $100 loss. Now, if we were using hedging, instead of, if we're saying for the sake of simplicity, this is a one standard lot sell, this would be a one standard lot buy. What are you doing? Hedging just says it's where you enter an equal and opposite trade. In the context of Forex trading, that's all it is. You're in a sell for one lot and it goes against you, then you enter a buy for one lot. It essentially is like hitting the pause button. It just pauses the P&L. So you still take the loss, but you just take it in your open terminal instead of your closed terminal. This essentially just allows you to kind of like wait until price moves to a new location, and then you can either add a sell or add a buy or close a portion of one of the trades in profit and then see if it pulls back a little bit and get out of the rest. There's a bunch of different ways you can do it, but essentially it's just you going into an equal and opposite trade. That's it. So let's see what would happen here if we're in this amount of loss and we're in one standard lot here for a sell, one standard lot for a buy. We've paused the loss at $100. Let's just wait for the market to move somewhere else, and then let's gonna see what we can do to get out of this. I'm gonna let it spike up a little bit more and see if it can go make a higher high. Okay, so price is going down. Let's let it go down a little bit more. See if it can make a new low. We're essentially waiting on a new trading opportunity. Okay, so now price has gone down here. Here's what we can do. This is a sell, right? That's the buy hedge. And this, I know this took ages to play out. This is just an example. Please keep that in mind. This took like 2 months to play out. This is just an example just to illustrate the idea of hedging. What you can do is you can close this trade here in a profit because that's about a 1-to-1 risk reward ratio, right? This is a $100 loss. When price went down here to make a new low, you could have closed that at like a profit. And then the idea would be, okay, so now you've closed that as a profit. Now you've got this trade sitting in drawdown here. So you're in a $100 profit from this winning trade, but now you're in a $200 loss on this trade. So we're going to say you close the trade right here in this region. It's down here, but just I'm keeping it flat. That way you can see it. Now let's see, you close the sell and profit, then you add a buy, right? And it's for the same lot size at 1.0. The idea would be that if price can go all the way back up here, then you would make a huge profit on that second position, and then you break even on the first position. If price can just get right here, that'll be about halfway in between both positions. Then you can close both the positions at a net break even. So let's see what happens. So right here, let's just say you close right here at a net break even. So now what you may be thinking is, okay, this is great. I can just hedge every trade that I'm wrong about, and then I just wait for it to go somewhere new, close a profitable trade, and add to the losing trade. The problem is multiple losing streaks. So when you're wrong 2, 3, 4, 5, 6, 7, 8, 9, 10 times in a row. That's why when you're using an approach like this, you have to use small position sizing, but it's kind of the same if you were to just use a stop loss. You can do exactly the same thing with the stop loss though, and let me show you. Whenever you add to this losing trade after closing the profitable trade, now you're in one standard lot buy and you're in one standard lot of a buy down here. So it's a total of 2 lots net long after you've closed this trade. What you can do is if you were to get into this trade and it lost, right? Price went up here. Instead of getting into a hedge position, you can just take the loss right there. So this is minus $100. Then you just wait for the next trading opportunity. This was that next trading opportunity, the next spot where we bought at. But instead of doing one standard lot, you just add one extra unit of risk. So the idea would be you would use 1 lot, and then you use 2 lots, and then 3 lots, and then 4 lots. This is not martingale. However, it's like a pseudo martingale approach because you're risking a little bit more on subsequent trading opportunities. If you were to do this using hedging, right, ideally you'd use the same fixed lot size, but that adds incremental risk to the trade. So it's like martingale, the risk curve would be like you down here, and then it starts going up exponential, right? Because you're doing 1 lot, 2 lots, 4 lots, 8 lots, 16 lots, 32 lots, and it gets insane, like very, very quickly. If you're just doing incremental, right, this is just like very, very not risky compared to martingale. Then you're doing 2 lots, and if that's wrong, the next trade is 3 lots, the next trade is 4 lots, and you're just essentially doing this over and over again. Or you can do it based on a fixed risk per trade, right? For this, instead of risking $100, like what you lost on that first trade up here, you can buy here, but then you can put your stop loss down here and your target up here, and you can risk $200 instead. The next trade, if you lose this trade, then what you do for the next trade is you would, instead of risking $400 per trade, that's doubling your bet. That's not the idea here. The idea is just to add 1R unit of risk to it. So that way when you get into a losing streak, even if you get multiple losing streaks, like it won't get like as crazy as quickly as martingale. Then you can start your next trade with a $200 risk, and the next one will be $300 risk, and this one will be $400 risk. So you can do the same exact thing with a stop loss, except now you don't have to wait this long, right? You take the loss in the trade, wait for another trading opportunity, you take it, but you just take it with a little bit more risk than what you did in the last one. The idea would be that if this trade won, and now instead of $100 risk, you're making $200 if you win, you will make $200 if that trade wins, and since it did, you make $100 back from what you lost on this trade here, and now you've made $200 total profit here, so you've made $100 back plus $100 profit. A lot of people think hedging is really cool, and keep in mind, like it worked for me for a very long time, right? I used this until I realized that, okay, stop losses are the same thing. You still have to wait for the next opportunity to trade at, and then that will determine whether or not the total outcome is a break even or a profit or a loss or whatever. It seems very attractive though, and I've noticed this is the one thing that it does for traders, and it's psychological. There is no tangible benefit to hedging. However, psychologically, you can argue that there might be a benefit, and here's why. Whenever you take a loss, especially if you take 2 or 3 or 4 losses in a row, this can do something weird to your brain. You can start taking trades you wouldn't normally take afterwards. You're going on a losing streak. You start doing what some people call revenge trading, which is a very foolish novice practice of you start taking trades that you would not normally take under certain market conditions. And then you start essentially, people call this gambling, where you start risking an exponential amount more for subsequent trades. Now, again, using this other approach with fixed stop losses and hedging as the risk structure, but just doing it with stop losses, yes, you are risking more for subsequent trades, but you'd be doing that anyway, even if you were hedging, whether you realize it or not. You hedge, wait for the next zone, you add to the losing trade. If that doesn't work, you hedge again a second time. Then if that goes further up, then you close the profitable trade, then you add a third time to losing trades. You're essentially giving yourself multiple opportunities to be wrong before price then reverts into your favor, so that you can either break even or get out of most trades in a profit. So profit or break even. Whenever you're doing this though, the psychological benefit is the fact that when you hedge, you don't feel like you've taken a loss. You just feel like, no, it's hedged. You know, it's not, it's just paused. And it's very weird because it's the same exact thing as you closing the trade. It just moves the loss from your open balance, because it stays there, right? When you're short 1 lot and then you buy 1 lot and it's $1,000 of loss the moment you did the hedge position, it's going to stay at $1,000 drawdown minus swaps and commissions and other fees like that. And so, but it's just very funny. A lot of people I've seen it gives them a psychological benefit because they don't feel like they've taken a loss, so they don't worry about it. They're like, I'm going to wait till price gets to the next zone, then I'm going to close the profitable trade, and then I'm going to say you got into a buy and it broke the support, so then you hedged with a sell, then it goes down to the next support level, then you buy again down there after you close the sell. If it bounces up, then you can just close everything when it's at a net break even. Now you made profit on the sell and you closed the buys at break even. And so you were completely wrong on the outcome, but you still made profit because you had a net profit on the sell, which was the hedge. Then you had a net break even on the 2 buys. The first one you screwed up, but the second one it bounced right there. Then you close everything at a break even. Again, you can do the same thing with a stop loss. You enter a buy at the support. If it breaks the support, you get stopped out. What was the risk? Let's say $100. You lose $100. Just wait for it to go all the way down to the next zone. And then what you do is you just buy down there. But instead of $100, you risk $200. And so then if it bounces there, you make back what you lost in the first trade plus $100 profit. If it loses that second time, now you're down a total of $300. You do not double your bets for subsequent trades. Again, this is not martingale. This is just you're incrementally increasing your bets. It is not exponential. So instead of risking 400 on that next trade, this will be the third opportunity, you just risk 300. Now, if you're wrong 3 times in a row and you just win that last trade for 300, you make back the previous 2 losses. So you're essentially break even, right? This gives you, like, when you're wrong 3 times in a row, right? In your trading approach, you're wrong 3 times in a row and you just break even. So it's not that big of a deal. Now, what if you're wrong that third time? So you're going to be losing 300 plus 300. That's $600. What are you going to risk for the next trade? You just incrementally go up 1, which is just $400 risk. So you're risking 400 on that next trade. Now, if you win that 4th trade, right? You're wrong 3 times in a row and you win the 4th trade. Then what happens is you make back everything up to still sitting at a $200 loss because you're down 600, but you've made back 400. Then for the next trade, if you win that trade, the next trade you can choose to risk either 100 again or 200, and it's all up to you. Now you can modify this risk structure multiple ways. The whole point of this video was not to tell you that you should do this, but just to highlight that there is no real tangible difference between hedging versus just using stop losses if you do the stop loss approach in the way that I just described in this video. If you find hedging works really good for you, but you're like me living in the United States and you don't really have a broker that you can use offshore, or you don't have any other like unregulated broker platform that you can trade with because you're a US citizen and you have to trade with a broker, you know, like Oanda or IG or Forex.com or another regulated Forex broker here in the US, there's an anti-hedging laws and there's FIFO rules. So like you can't really trade like you normally would be able to if you're using a degenerate unregulated offshore broker that allows hedging and really high leverage. However, you can still do this if your position size is small enough, you don't exceed your margin, and if you kind of plan out the way things are going to look. You cannot do this risking like 10, 20, 30% on your first trade if you're using this as a risk structure. This as a risk structure combined with some sort of a predictive edge works pretty well overall in my experience. However, my trading approach is even simpler than this. I just buy when I think it's going to go up, sell when I think it's going to go down, and I just have a really wide stop loss, and it allows me to manage the trade dynamically when I'm in it. I can close it early, I can add to it, whether it's losing or winning, and then I can manage it. It's all based on my 8 years of experience. But if you're going to be doing this and experimenting, just remember, you can do the same thing as hedging as you can with a stop loss. Just depends on how you actually go about implementing the specifics of that. I see a lot of people still ask me about my videos that I've made like 2 years ago from the time I'm uploading this video, back when I was using hedging as a risk structure, up until I realized that using a stop loss is the same thing. It's just simpler depending on how you execute it. So that's why I want to make this video. I want to make this video to kind of offer a little bit more insight and offer a little bit of an update to that. I hope you enjoyed it. If you're not my free Telegram channel, make sure you join. It's just a free Telegram channel that I've been running for 6 years where I share my insights and analysis every day. And you can join from the link in the description or the first link in the pinned comment. Enjoy.